20% down. You need a 20% down payment to buy a house. Wrong. But you do need a good chunk of change. We're going to talk about it, and we're going to dive into it. The starting place. We're going to do a little bit of big categorization here. You need your down payment, which is where that 20% idea comes from. Lovely handwriting, thank you. And you're going to need your closing costs. People don't really talk about this one, and honestly, this is the reason you don't have a general X amount of dollars to buy a house. This guy changes a lot of stuff. And over here, you're going to have your reserves. No one really talks about that one, but you're going to spend all this money to buy a house. You're still going to need money after all your expenses. You're going to need to pay your bills. You're going to need money to maybe make some projects and improvements to your new home. So that matters. Now, down payment. What did I say? 20%. That's the number you have to buy a house. No. That is the difference between PMI or no PMI. And what is PMI? PMI is private mortgage insurance. Lenders are not giving you money to buy a house out of the goodness of their hearts. They are doing it to make money, and they're doing it to make money on their interest that they're going to charge you, and they're not wanting to take on the risk of if you default. So if you have borrowed and put less than 20% down, they're going to charge you private mortgage insurance for in a just-in-case scenario where you default and don't pay them back. They want to make sure that once they have enough in the property, they can now recoup their losses. But if they don't have it sitting in the house yet, they're going to want you to pay for it. How about that? Now, let's dive into loans. If you are getting a loan, there are lots of choices. We'll go over some of the more conforming standard ones and the differences for those down payments. So, conventional loan, standard, you qualify in most ways. 3% to 5%. 5% being more commonly known, 3% being for first-time home buyers in certain programs. That's your down payment amount needed to buy the house through that loan product. FHA is a government-backed loan. 3.5% in general is what you need to start a loan and have a down payment for an FHA loan. VA, USDA, you are a veteran of this country, the United States, or you live in a rural area and you qualify for the United States Department of Agricultural loan, where you're actually going to put 0% down. Woohoo! Phenomenal loans, but very caveated. Now, these will obviously be the amount you need for your down payment, depending on your purchase price. Closing costs. This is where it gets wonky, and this is why nobody likes to talk about these videos, because this is a range of ranges. If you're not getting a loan, there's a whole chunk of closing costs that don't apply. And those are your loan fees. Lenders charge different fees. Different lenders have different setups and different ways that they try to make money. Some charge what I call trash fees, where they're going to charge you for a credit report, and they're going to charge you an application fee, and they're going to charge you to call your employer. Like, there's a bunch of just trash fees that they're going to just ding, 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 all the way up to closing. Others are a one-time flat fee. Some are percentage-based. So, in general, to get a loan, you're talking anywhere between $500 to maybe 1% of the loan being originated. There's also going to be an appraisal involved. The bank is going to charge you to have a third party come out to value the house to make sure that what you're about to pay for it, what they're about to lend for it, is worth it. That can charge nowadays $500 to say $800. Things are getting more and more expensive. It's August 2026 right now, so that's accurate. I think inflation's coming, so we'll see how long that stays accurate. And then from there, you're also going to have to think about your inspections. Inspections are going to be a big range as well, a range of ranges. It depends on how much you inspect and what all you want to pay to inspect. If you're getting a home inspection, you're getting a radon test, you're getting a pest inspection, you're getting an HVAC inspection, you have a septic tank, you have a well on that house. If you're paying for all those things, inspections can easily tally up to $2,000 Pretty simple. Regardless, if you're being a little bit more cost effective, $1,000 you can do a good range of inspections with. And if you're really trying to run the gamut and do water tests and air quality tests and all sorts, like, you can easily break the bank and hit the 3K mark if you want to. Now, title. You're going to need to convey the house from one person's name to yours. And who's going to pay for that? You! So, title. Whether you live in an attorney state or a title state, you're going to be paying somebody to look up the chain of title and to originate a title policy. Title insurance is a one-time insurance payment. Usually the lender is going to want a chunk of that, so there's going to be a mandatory loan version, and then there's going to be owner's title if you want some for you. So title insurance is just one chunk of title costs. Title itself is going to be paying someone to do all those services, and that can range from the $600 to $1,000 range just to do their job. They're going to also be doing all the recording fees and the prorations of taxes and all your escrow setups. So they do their work for sure to earn that check. And then those are all going to be more things you have to budget for and pay for. And just to be running out of space on this column, to be succinct at this point, you have to think about the escrow for the loan. That's going to be them setting up months of reserves and charging you for the property taxes and the homeowner's insurance that they're going to be paying on your behalf through your PITI payment, P-I-T-I. Man, I could go into more terms here. I hope you know this stuff. If you don't, I'm here for you. Escrow is going to have a good setup. We're going to call that another $1,000 easily. And then we still didn't finish title. So I mean, if we talk about the excise taxes over here, that's a good couple $1,000. If you're talking about your homeowner's insurance over here, homeowner's insurance, I mean, that can easily be a range of $1,000 to $2,000 depending on how expensive a home you're buying. Getting complicated. Now, reserves. You're going to spend all this? You still need some money. That's up to you to decide, really. Are you buying a project house? Do you want to have money set aside for some projects, some painting, refreshing, new curtains, what have yous? You still need to pay your bills, so 3 months of reserves to pay your bills for your Wi-Fi, your phone, your car, all that good stuff. It's a chunk, right? Now, let's do a specific. Let's dive into like numbers for a specific house. Let's say you want to buy a $350,000 house, and you're also going to be using a conventional loan, and you're going to be putting 5% down. So your down payment, pretty simple. You get out your handy dandy calculator. You do 0.05 times your $350,000 purchase price, and you're going to need $17,500 for a down payment. 7.5K. You're going to need to save that amount for your down payment on that house. Now, your closing costs. Simple way to do this, in this price range, 3% is a good cushion. Now, obviously, if you're buying a less expensive home, $200,000, some of these costs are flat, like the appraisal's not going to change, the loan origination's not going to change, the title isn't going to change. They're still going to charge what they charge, whether you're buying a cheap house or a really, really luxury, expensive house. Now, so I would budget for 5% closing costs. But if we're talking luxury and you're buying a $750K house, 2% now can work well for your closing cost projection. Now, back to ours. We're going to be simple here. We're just going to say, all right, for closing costs, 3% closing costs is a nice safe number. 0.03 times 350,000, 10.5. Now, let's say your monthly bills, yours to know, but if it costs you $5,000 to $6,000 a month to pay for everything that you do and enjoy, and you want a 3-month reserve plus some stuff for paint, we're just going to call it $6,000 to $7,000 a month. times 3 months of a reserve, you're going to want $21K over here. So, to buy your $350,000 house where you feel comfortable, safe, and happy, with 5% down and closing costs paid for 100% by you, we're going to have a little highlight on that in a second. You're going to have, what's our quick math here? Who's fast? 2, 3, 4, 7, 5, 4, 8, 9, $49K in the bank to buy your $350,000 house. But you have a good realtor, and it's a market where you have some leverage. You can negotiate this one into the contract. So, you get closing costs paid for by the seller. Let's say they pay for $9K. You negotiate well. You get the house. Maybe it was listed at $360. You're like, hey, that's nice. I'll give you $350, and I want you, Mr. Seller, to pay $9K in closing costs. And they say yes. So you saved $9K now. You only need $40K to buy the house. But that's not a guarantee. But that is something you can do if you're creative and trying to leverage. And even if you have $49K in the bank, you can still try and do that if that's something that you can negotiate and save yourself $9K. Why not? I hope this was helpful. I know it's a lot of information. You want to dive into escrows and pity payments? Maybe we'll make another video. Regardless, my brain's yours to pick. Talk to you later.